As the who's who of the world meet this week on the icy slopes of Davos, questions do linger as to whether or not the global economy will pick up momentum in 2019, boosting market performance, or will the IMF's growth forecasts prove to be right? And the IMF is not exactly in the most optimistic frame of mind. The fund this week lowered its global growth estimates from 3.7 to 3.5% for this year. Doesn't seem like a huge downgrade, but a downgrade it is. I'm Bruce Whitfield. This is Taking Stock. And joining me for a look ahead to the markets and the world economy in 2019, the Chief Executive of Vestact, Paul Theron, and Portfolio Manager at Sasfin Nesan Nair as well. Do you care about Davos? Does either of you care about Davos? You've never been to Davos. Have you been to Davos?
No.
I've been to Davos. It's like, have you done an MBA? I've not done an MBA, but I've been to Davos, and it's cold and hard to really find a point.
Yeah, and of course, minus the U.S. President Donald Trump as well.
Well, that's a big improvement. But the reality is, it's not a global decision-making forum, but it is a place where ideas are exchanged. Does it matter in either of your lives one jot, Paul Theron?
No, not at all. Although I can appreciate why the corporate titans who pay to go there find it useful, because it's all the media and politicians that come and that they can then network with in one place that makes it worthwhile. So it's a good business model, I think, the WEF has, and good luck to them. You know, as Nesan says, a whole lot of important politicians, including Theresa May and others, no show. Jair Bolsonaro from Brazil is the leading act, which tells you something.
But what this Davos tells us is more from omission rather than commission. The fact that Donald Trump's busy dealing with the government shutdown and his wall debate. Theresa May is so desperately trying to put out Brexit fires that she can't be there.
Macron also not
Emmanuel Macron is dealing with yellow shirts, yellow vest protesters. The Chinese are dealing with a bit of a slowdown of their own. It tells us perhaps that the world is possibly the least comfortable. I don't want to say the least stable, but certainly the least comfortable it's been in a decade.
The thing is about Davos is you hear about it in the third week of January or whenever it takes place, and then for the rest of the year, you know, there's nothing. No, there's no follow through. There's no, you know, unless there's a big deal that's done. You know, it doesn't sort of, it sets a tone for the year, but you know, you don't really hear of any follow through throughout the whole year.
That's because it's all secret. Only those who know.
I've heard it referred to as a circle jerk, so I don't think you want me to do a demonstration of what a circle jerk is.
Please don't. It is certainly where people, like-minded individuals, can get together and swap ideas about the future. Global growth forecasts. IMF says global growth from 3.7 to 3.5. China growing at its lowest level since 1990. But growing still at 6.5%, compounded on, I mean, growth rates of 13 and 14% of a decade and a half ago. This is a rapidly growing economy, narrowing the gap between itself and the US as the world's biggest economy. Is that keeping you awake at night, that everything seems to be slowing down a smidge?
I wonder whether that, you know, that's to be expected or not. You know, when you're growing off a small base, you're going to grow at a higher rate.
Yep.
But when you're the second biggest economy in the world, you can't be expected to grow at, you know, 7-8% any longer. You know, the rules of compound interest means that you'll just, you know, grow into infinity if you grow at the same rate. So I think expected. But the concern is there's, you know, who's going to take the slack from China now? Now, India, they say, is going to grow at 7.5%, and it's one of the biggest growth rates in that region. But again, you know, they're growing from a small base as well. US growth numbers also expected to come back as well. So I think generally the sentiment is we're going to see softer growth compared to 2018 without anybody else taking the slack from the economies that were naturally expected to grow slow.
I mean, one of the Davos sort of pre-Davos surveys that was done was all about CEO confidence, and for the first time in years, the vast majority of CEOs going there are worried about the future. But that's their job, isn't it?
Yes. Look, I don't worry too much about the global backdrop, because the IMF, World Bank, you know, their numbers always seem to be around 3%, and you get some winners and losers. I'm much more interested as an investment advisor in trying to work out which parts of the global economy are going to do well. And that's partly a regional discussion, but it's also partly a sectoral discussion, by which I mean, you know, is oil going to do well? Are clothing companies going to do well? Is IT and global You know, search engines going to do well? Is it a good time to be looking at healthcare? Should one avoid the construction sector? These are the questions that I think are much more practical.
What are the answers?
Well, I think my view would be that there's going to continue to be rising income levels, and the middle class is going to do fine. And I do think those big cap tech stocks and healthcare sector are the place to be. I think one must
the Amazons and the Facebooks and the Microsofts of the world
continue to avoid all that cyclical commodity rubbish, because it's too complicated to work out what's going on there. Avoid anything that has to do with infrastructure cycles and politicians and all that sort of thing, and be very, very careful of retail, because while the consumer is looking all right, there are always winners and losers in that space, and it's tough to get right. And we're seeing that in our local market at the moment.
We'll talk about that in the second segment, because we've had a number of trading updates this week which give a very clear picture of just how rough and gloomy the world is. As an investment strategy, sectors, very, very carefully chosen picks within those sectors and within growth regions as well. Paul's focused very much on the United States.
Yeah, so, and I think that's exactly the way to look at it. I mean, the world's always going to have problems. There's always going to be a war somewhere. There's always going to be economic turmoil and, you know, unpopular presidents elected. We just accept that. But as an investment advisor, you've got to focus on where you are going to see growth in your underlying investments. And I still think, you know, IT is the place to be, global IT. If you look at the last 10 years, social media has been the thing to invest in. I think that area of IT gets a bit harder going forward, especially with the privacy issues, and I think we're going to see an intensification of that. And we're focused on what's the next sort of subsector of IT to look at. And if you look at things like cloud, online retail, internet on demand services like Netflix and, you know, Amazon Webs, Amazon Prime, for example, I think those are still areas that are in their infancy. I think we're going to see a proliferation of services along those lines. 5G, for example, you know, talking globally. I think those are the areas in IT to focus for the next 5 to 10 years.
What about the doomsday artists who say we're so far away from the 2008 crisis that this world has grown at such a pace that surely we must be ready for a massive correction at some point? Lots of commentators, hedge fund managers, people forecasting another crash. Some saying later this year, some saying into 2020. It happens eventually. That's what happens in markets. They get overexcited, get over-enthused, and then fall on their faces from time to time. Yet nothing in the global economy, and we must separate markets and economies here, suggests that we're headed for a crash. Yet, anyway.
Yeah, you know what they say about fools like that, those doomsayers, is that they predict, you know, correctly 2 of the last 15 recessions, or they predicted 15 of the last 2. You know, they are in permanent pessimism mode, and they're always saying, you know, terrible things lie around the corner, and in general they're wrong, but then they just restate those things time and time
until
again.
They're right, and then look like geniuses.
When things get unhinged like they did in 08, 09, then all bets are off. But those things are very rare, because we have been hard primed now in markets and in economies to, you know, buy the dip. And Federal Reserve central bankers normally come to the party and so on. So if you look at history, the frequency and duration of gaps between recessions is becoming longer, and they're becoming less extreme, and the stock market is more inclined to recover quite quickly after a 10 or 15% fall than it used to be. So my general view is that people should prepare themselves for an era in which we have less of those kinds of surprises, and calm down and shut up and not exit their profitable investments.
Perhaps we had that in the last quarter of last year, when there was a massive correction, in particularly those FANGs type stocks, the Facebooks and the Amazons, the Netflixes and the like. There was a big pullback at the end of last year.
And we've seen a 15% increase since Boxing Day.
Yeah.
So we had a terrible final quarter, as you say, but we've already seen the bounce. And that's because big money investors have learned that these dips present buying opportunities.
I mean, even if you take the 2008 crash, which was horrific, you know, on many levels, you know, people lost their homes, lots of people were out of a job and things. You know, 2-3 years down the line, the market had actually recovered from that.
Yeah.
You know, so you can spend a decade worrying about a correction, and you could be right. You know, what do they say? Even a broken clock is right twice in a day. But a lot more time, or a lot more of your time, you will experience markets that are actually rising.
That's what the history books tell us. But locally, we've had lots of bad news coming out over the last week or so, most particularly coming out of Massmart, which had a catastrophic trading update in which it warned in November and December last year sales fell off a cliff. ShopRite also reflected a negative period in November and December. We also had other clothing retailers come out with some warnings too that the Christmas period wasn't great. Amongst them, of course, was Woolies. More on this conversation and taking it a bit local as Taking Stock continues.